Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So that's an example on the MID. And let's look at now bearish rules. So now we're looking for two closes in a row below the 20-day lower acceleration band. So, when we look for that, we're saying, okay, this is a breakdown, one and then two in a row. And again, like to see it where the second close is lower than the low of the first bar. That's just a sign that we're continuing to break down. For most people, they get scared. They're chasing a stock or an option into that. There's ways to manage that. We'll talk about that with the substitute strategy. But again, once we know we can put a trade on with reasonably tight risk, a close above the 10-bar exponential moving average, that will tend to allow us the ability to say, okay, it gives us some wiggle room, but yet not too much. You can see that on the good trends, you don't need a lot of wiggle room. You shouldn't want it. That'll get you in trouble. So you want to have it be clean and consistent, keep on trending. So that close above the lower acceleration band is not quite as good as the holding at the 10-bar exponential. So let's look at an example there. So now we look at another ISE index. This is the Oil and Gas Services, ticker OOG. And you can see on this chart, here's an example where, you had one below, but then look at what happened on the second one. On the second one, it closed back into it. So that's where we would literally put an X through that setup because it didn't follow through on that second day. Compare that to what we have happening as you see the one and then the two closes in a row below that really tells you that, okay, things are starting to heat up on the downside now. So now you've got this very steady decline kicking in for energy back in October, and you can see that then we're going to, ever so slightly, but what's going to happen, we're going to close just above that 10-bar exponential downtrending yellow line there. So from this perspective, you see then it goes into kind of a chop zone, and look what's happening here on the bands. Now the bands are forming a support. So we'll see support when we're not getting the real breakdown of the bands for those two straight closes. Compare that to when we do indeed start to break down. That tells you where the opportunity is in the short term. So this is what we look for on a very, very regular basis. Now as we look at another example, again, this is keyed off the daily charts. But you can also do the same kind of analysis on an hourly chart, a 15-minute chart, a weekly chart, a daily chart, you name it. So what you're looking at here is incredible consistency. The banks, we've been quite bearish on them for a while. You can see we had a situation here in which this ISE U.S. Regional Banks Index, ticker symbol JLO, and basically had one and then two closes underneath. And you can see that was coming in the neighborhood of about 34.5. Now, I'll get questions a lot of times from option traders asking, well, what should you do here? Should you buy or sell an option? Should you buy a put option or should you sell a call option or call credit spread? You could do each, but you notice that when you're getting the breakout outside of the bands, usually from my perspective, I've had better success being an in-the-money options buyer. So, for example, a put option buyer when the stock's 34.5 might be interested at 36 or 37, something in that neighborhood where there's some decent intrinsic value. So that bottom line is that, you can take advantage of that move without having to feel stuck in it. So that's very, very valuable as well. So, you can see, by the way, how long that lasted. You can see we tested a couple times right into the 10-bar exponential here, but we didn't close above it until where? Until right there. So that was happening in the first week of July. And so, from this perspective, you say, well, it has been pretty noisy, and in this kind of scenario, we're saying, okay, look, we would expect to see that kind of steady trend. You can see the best sweet spot, of course, is where? it's why you're breaking below the lower bands. Once you kind of go back into it and then kind of test back down, you can see that while it's still dropping there late June, early July, it's definitely later in the game, so to speak. So that's, in a nutshell, one of the things we look for. Notice, by the way, when we test right up into the upper band, but we stall there, I get people ask me a lot, well, why not sell some call credit spreads up there at the upper band? You can do that as long as you have confidence that we're going to stay stuck in a trading range. The downside of the call credit spread, which is still a good strategy overall in the choppy market, I tend to be a bigger fan of put credit spreads, but, again, there's a variety of ways to go there. And the thought is that, look at all the tests that we have, and it finally gives it up there in early July. So, then we're starting to come back up, and you see that, generally speaking, the stock or index in this case is actually, stuck at that range, bouncing around, but still improving. Also, you check out like the mini NASDAQ 100, the MNX. There's just a lot of different vehicles you could use here, but bottom line is that sometimes you'll get an initial breakdown, and you can see that's happening right in here, and then look at what happens. We actually go back above the 10-bar exponential, and you're going to lose a little bit on that first trade. So you can see that the first one came in where? Right around 227, and then this one you can see went out right here at about 235. So, that's like a pretty meaningful, about an 8-point loss in that kind of a case. So you're saying, geez, I don't want to take an 8-point hit, but then you have to look at when you're right, 1 and then 2 bars below right here, you're getting the new confirmation of a buy or a buy in the puts point, a bearish opportunity, when we're sitting at about 210. And you follow that one through and all the tests that end up holding, and you say, well, there's your eventual exit coming here, and that one's down at 175. So now you've got a 35-point gainer compared to a 7 or 8-point loser. So, from that perspective, you say, okay, well, that's more like it's like a 4.5 to 1 reward for my risk. So that's the type of thing that we're looking for all of the time. It may ask, what's the estimate of the probability and percentages of this method? I mean, I would say that, it's definitely in the neighborhood of probably 50% win and loss, and people always say, how can you trade something like that? It's because when it wins, like in this example, it wins big. When it's wrong, it loses small. It's keeping the risk down for all of our clients. So that's very important to us, and we really make sure that we're looking for those retest points along the way within the trend. Even if you get faked out in that last move, you can see, well, that last move was coming in about 139, and then by the time you got the exit right there, that was about 160. So you say, well, geez, you lost about 20 points in that case. Again, that still pales compared to the about 35 points you made in the prior example from entry to exit. So just things to think about and allow yourself the ability to really focus on that. Now, do we miss a lot of moves with a 2-bar entry requirement on a stock like Netflix? After 2 bars, the stock could have moved 20 points. I'm glad you asked that, Demetrius, because that's why a stock like Netflix, I'll take the daily chart and I'll work down to the hourly chart. So the hourly chart will actually get you in within a couple of hourly breaks outside the bands rather than a situation in which you're waiting on the daily for those really fast-moving stocks. The faster they move, the more quickly you need to put something on them to really have a sense of where they're headed and what's next. So that's an example with the NASDAQ. And then, let's take a look at a reminder about the stock substitute and index substitute strategy. What is this substitute strategy? I mean, to us, it's a critical trading vehicle. We really believe strongly in it, to the point where we've put a lot into finding these type of opportunities and pointing out what for folks should be some opportunity to really put your knowledge to work. Now, one of the great challenges is that what's your biggest enemy as a trend trader, in my experience? It's the noise of the markets. By the way, Robert asked, what's our minimum open interest and daily volume of options that we'd like to be seeing at a minimum for safe liquidity? I mean, yeah, in a perfect world, we'd like to see, at least a couple hundred contracts and minimum volume daily of probably about 100 contracts. But it's not always perfect. Sometimes we'll go below those standards. But the basic premise is that, we will, make sure that we're going to definitely trade very liquid situations. The other aspect is you want to see good stock volume. So we look for very active stock volume, usually over a couple million shares a day on average, just at a minimum. So that there's not a problem in the market maker being able to hedge against the options that you may buy. So the idea of how do we get around this intraday noise is to consider only using a stop at the end of a given bar. Now, if it's a daily chart, you got to wait to the end of the day. That may seem like an eternity for you active traders out there, but that's why you can work it down to a 60-minute chart, work it down to a 15-minute chart. You have the opportunity here to really identify whatever time frame you want to trade and then zero in on those opportunities. Now, when we talk about what the goal of the closing stop is, it's to avoid as many of the numerous whipsaws as you possibly can. Because when you get whipsawed, it's not just what it does to your financial capital, but it does something to you psychologically as well. It messes with your trading confidence. We must be vigilant about protecting our trading confidence at all times, because that's something where we need that confidence in order to be able to follow our rules, stick with the system, not get into that woulda, coulda, shoulda game. Anybody could do that. It doesn't really serve you much good. Now, for a daily closing stop, I'll use the price 15 minutes before the end of the session, and then it says if the stop is violated, place a market order to exit the position. Either a market order, which will get you out at the bid at the time, or you could place a limit order with just a little bit of room, meaning that if the option is, say, bid 5, offered 520, you might say, well, get me out at 490 or better, even though you think you're going to get filled at 5. It's just saying, well, in case you don't put it in, if you put it in at 5 and it immediately starts dropping down, you're going to miss it. So you'd like to kind of, come back to it in that sense, and that'll make your job a lot easier. Now, Demetrius also asked, do we wait until the market has been open for 15 or 20 minutes before making an entry to adjust for volatility? He said he'd imagine that I could get a 2-bar entry within the first 10 minutes only to be faked out. Well, again, it depends. So you're talking about, say, a 5-minute chart. There's definitely a lot more noise on a 5-minute chart. So from that perspective, you have to factor that in and say, okay, how do we deal with that? Well, one way is to consider a little bit of a longer time frame. But the other aspect is to say, well, if you're using a 5-minute chart and it gives you that breakout and that confirmation, we'd be getting a signal potentially as early as 10 minutes into the trading day. You possibly could have had one right at the end of the prior day and need to execute that right at the open. So there's a lot of different facets to that, but this will help you quite a bit to avoid these closings, these whipsaws, and say, we can't get rid of all of them, but we can reduce them by using the closing stop concept. What's the shortest term time frame that I would routinely trade, Eric asks? I actually don't like to usually go below a 15-minute chart and 15-minute candle. So, for me, that's really my preferred sort of lowest, shortest time frame, because that's also one that has an average holding period in my work of a couple of days. So that fits very well for what we're looking for here. Now, okay, let's keep it moving and look at some more key principles. So with the stock substitute, in this case, index substitute strategy, we're buying in the money options. So we want to get rid of as much time value as we can and put more of the focus on the intrinsic value. So if we sold short 100 XYZ shares, thinking the stock's going to drop to $50, then that 56.60 is you can see showing up that you have to type a bunch of that money in margin at least to go short 100 shares. Well, instead, if you bought one December 60 put, that you see a situation in which you're paying $470 for it. Well, again, what's the stock trading at? 56.60. You own a December 60 put. That gives you a right, not an obligation, to sell the stock at a fixed price of $60. That's what a put is. It's the right to sell. So if you have a right to sell, then you can see in this case that if it goes down to 50, what's a 60 put going to be worth? It's going to be worth $1,000. Well, in this case, you can see the short shares gained $660. The in the money's gained $530. So that's where you can see our leverage kicking in, that paying almost 1/10 the value of the stock, it gives you an opportunity to really focus in on, wow, what is going on here? Well, that's why there's about a 10-to-1 leverage ratio on the in-the-money option that behaves very similar to the stock compared to the out-of-the-money options. At or out-of-the-money options are 100% time premium. That means even if they go nowhere on the underlying, you're still going to see that bleed in the melting ice cube, if you will, in the time decay curve of options you buy that are near the money for any particular stock or index. So how far in the money? Well, typically my rule of thumb is I like to get at least 2/3 intrinsic value, and another rule of thumb you could consider is that I generally prefer at least a 75% delta, meaning that we're going to get a good bang for our buck. So the stock goes up a point, the delta of our options is 75%. That means the option value went up 75 cents. So on that 1 point move up. So that's where you start to see the leverage because you're paying very little, but you're getting similar moves to the actual underlying stock. Our acceleration bands, common technical item on charts, they are definitely out there. You'll see them across some different platforms. The bottom line is that, you have to make sure it fits for whatever type of trading you're doing. And so, like I said, for %R, what we're looking for, most people use like a 10 or a 14 bar setting. I'd suggest that you should can those because they don't work as well as what I find, which is I like a 30 bar setting. So when we key on that, we say, well, then what does an overbought reading look like? Well, overbought on the 0 to minus 100 threshold is that if we get a reading above minus 20, then if you see a close, that's the key word there, a close above that bar's high, then we're bull confirmed. For a bear trend, we want to see it go quote-unquote oversold with a reading below the minus 80 threshold, and then a close, and that's the key word here again, a close below that bar's high. That bar's low. So it's continuing to drop, and that's what you look for in this type of a situation, is you want to see it continue to drop and follow that through. So when we look at %R with the 30-bar setting, and you can see, and by the way, these charts are pulled off of Metastock in this case, but you can see that this is the ISE Electronic Trading Index, ticker DMA, and you can see that we get the buy signal coming in here as we've been hovering around those prior highs for a couple of days, and then we finally like, woo, okay, now we're ready to get moving here. So, you get that initial little pop. You can see where we're getting some good low-risk entry points right off of this spot here. So you don't have to close it out unless it closes below there. You can see in this case it doesn't. It flips right back up. And so that's what we were looking for. Now, you did get knocked out by this move underneath that threshold, and then we had a situation in which, okay, that's something that we don't need to be a part of, but then you can see it's going to get us back on the wagon here yet again when we break out and then confirm right back here. So nice confirmation. And look at how long we stay overbought. That's happening for almost a month and a half. That's about 30 trading days. Well, not surprisingly, the %R length is 30 bars. 30 bars is what we're measuring here. Now you can see once that's over in the middle of January 2011, you can see at that point that then it's like, okay, bye-bye, done with that trade, and so time to move on out. So again, it helps when you're buying those in-the-money options. You can just ride that out, even if it has that last little pullback against you. Sure, of course that's going to eventually happen, but the idea is you're trying to keep it as focused as possible. So definitely makes a lot of sense there. Now, how about this is the ISE Revere Walmart Supplier Index, WMX. And again, just look at how powerful this is. Now, what I love about this is when you get the breakout here and then you follow through, that's the first buy signal, right? But look at what happens if you miss that first wave. There's a retest coming. These retests are so powerful because they give me the opportunity to get back on board the horse if I miss that first move for whatever reason, and then it allows you the ability to really see that quite clearly. So, from that perspective, you can see that we're steadily trending, and then we get the really nice pop right in this area, and so you see a situation in which, okay, now there's another retest coming in right there, just a couple of days after the entry point, at a slightly lower level. So, like those retest points in the terms of that they'll give you relatively low-risk entry points. Do all of them hold? No, of course not. Sometimes you're going to have to cut and run. But the beauty of putting them on into those retest points when it pulls back to the 80 threshold after it's been broken out to the upside is that it gives us relatively low-risk points, and it gives us the confidence that we're able to execute that effectively. You can see again how long we stayed overbought, and then by the time it finally gave a retest, it was a little late there. So basically, getting that retest, and then of course the violation, and then we're back into a no man's land. So we look at the mini FTSE 100, the UKX. This is tied to what's going on over in England. And so you can just see how powerful a couple of these downtrends have been as you look back in time. I mean, just phenomenal, great retest. You see, of course, the bear signal happening. And then here we go. We look at that one. And, all these are just what I call retests, that just pops up within a downtrend. So where does a retest end? Well, once it pops back up and then it fails to hold the attention, it's like, okay, now that's where the exit is, and you say, okay, well, now we'll wait. We can see this one actually gave a little short-term buy signal, even though you can make a case that it was below a 200-day and some things where maybe we would change that down the line. But the bottom line is that you can see there's the retest coming in, and unfortunately this one is going to knock you out. You can see the exits happening right there or on the open the next day. Now, look at what happened since. We actually went into a bear confirm mode once we broke down below that low back in mid-September. So there's the bear confirmation, and then we get this sharp spike up. This is what I love about %R, that one day does not make a trend. That high, which was about 535, was another good low-risk entry point. And then you see yet another one coming in back here. So you see that happening, and then you see what just happened here on the snap-up kind of move early last week. Early in October, excuse me. And the bottom line is that from that point, every one of those keeps resetting a nice low-risk type of an entry point. So, again, just looking now at the NASDAQ coming down on the MNX, we can really show that type of an opportunity. Do we put the notations on here, or does the system provide it? I like it, Michael, where the system tells us what to do. It makes our job a lot easier. So the entry criteria, Israel asks, is what are we looking for here? Well, coming back down to, we show %R here, but it just shows the bands. But this is kind of keyed off the fact that you've got the bands happening here a couple different times from what we talked about before. And, the %R would help you manage this trade along the way. But, again, it looks like we missed putting that up there.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.